Hello, everyone. Today on the Final Bar, we will wrap the week. We will look from this Friday to last Friday. How have the markets evolved? Quite a bit is the answer. Last Friday, we had that severe sell-off, that first sign that really things were starting to get disrupted. We've seen further follow through to the downside this week. Bit of a rally into the close today, but overall the damage has been done with the S&P major averages going lower. What does this mean? The short-term movements of this week relative to the long-term trends. Let's look at it together. Ladies and gentlemen, this is the Final Bar. Hey, everyone. Welcome to today's edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here in a rainy Redmond, Washington. Thanks for joining me every weekday after the close as we focus on the market environment using the power of StockCharts, using data visualization techniques, the technical toolkit, the behavioral toolkit to understand what is happening inside our brains as investors, but really understanding how the markets can be quantified and visualized and analyzed using trend analysis, momentum factors, and so forth. You know, overall, my conversations this week with guys like Mark Chaikin, Tony Dwyer, and others have really been talking about this interplay between short-term weakness and long-term strength. And at what point do you identify a tradable pullback? When does something remain buyable? How long does something remain a buyable pullback? What would you need to see to turn less positive on an overall market environment? It brings up a lot of really good questions. The answers, the market's going to tell us over time for sure. But the best we can do is look back at historical precedent. What have historical pullbacks looked like? What have corrective phases looked like? What is a bull market by definition? And how do we relate the short term to the long term? We have a lot of great charts to show you to try to represent that market environment and answer those questions together. We'll get to it here very shortly. We have great guests on the show. I mentioned some of them this week, which have been absolutely top notch. We have more great guests coming up for you next week on Tuesday the 7th. Mark Newton, who recently joined Fundstrat Global Advisors in New York. On Wednesday, Gary Dean from sentimenttiming.com. Next Thursday, December 9th, we have Samantha Leduc from Leduc Trading. And the week after, on Tuesday the 14th, we have Jonathan Krinsky coming to us from New York. Also, as a reminder, we have our StockCharts holiday special happening all through the month of December. If you've ever considered joining StockCharts as a premium member, which gives you a lot more capabilities in terms of your ability to customize your charts, different sizes, different indicators, managing chart lists and scans, some of the most powerful parts of our website. You need to be a premium member to be able to take advantage of all the cool stuff that we show on the show. Go to stockcharts.com/special. Also, as a reminder, if you're an existing member, it's a really good time to renew your membership for the coming year. Let's continue on with today's Wrap the Week segment. We spent a good amount of our show focusing on how the markets have evolved. We're going to start with a brief poll question. We always have a poll running on our live stream page on stockcharts.com. We asked you recently, which of these four baskets do you think performs the best over the next 3 months? We gave you four choices: large cap growth, large cap value, small cap growth, small cap value. So if you know the Morningstar style boxes, the 9 with core, mid-cap core in the middle, and all the other combinations all around it, basically taking the four corners. Which of these do you think is most likely to perform well? Large cap growth got the most answer, over about 55%. Second to that, large cap value, 22%. So very interesting that over 2/3 of you, other 3/4 of you actually said large cap. One of the large cap spaces over small caps. 15% for small cap growth, only 8% for small cap value. So as a contrarian, of course, I'm looking right at that small cap value chart, thinking, all right, maybe that's the one we want to be focused on here a little bit. See if there's an opportunity. But I did want to show you this chart. This is actually the chart of those the S&P 500 in black, and then those four style boxes that we basically identified: large cap growth, large cap value, small cap growth, and small cap value. If you want to know the tickers, by the way, there are tickers for all 9 of those of those basically style boxes, right? So if you want an easy way to track these 4 themes and see over the next 3 months what actually does better than the others, this is the way to do it. These are the 4 tickers. If you hit pause or just jot these down very quickly, these are the ways that I brought in those 4 different ETFs. You can search for large cap growth and find there are plenty of funds and others that track the space, but those are the 4 that I use to track it. If I had to pick, I probably would say large cap growth as well, only because I feel that that is a good mix of defense. That's a place where I could see a lot of people go, names like Microsoft and Amazon, but also with some upside potential. These are stocks that have tended to be good offense and good defense. Not a bad place to be. Let's continue on our Wrap the Week segment, looking at our Wrap the Week chart. So this is the chart that actually looks at the major asset classes. We're looking just this 1 week. So we're starting the clock on last Friday's close and going to where we're at today. The S&P 500, given the weakness today, finished down for the week 1.25%. It jumped a bit higher yesterday, of course, but came back and not quite making a new closing low for the week, but getting down in that direction. A couple things outperformed the S&P this week. Gold and the US dollar were both right around the zero level. Gold was down about 1.1% using the GLD. The emerging markets index was up about 0.5%. And up here in red, we have the big winner, the bond markets, bond prices using the TLT, which is up about 2.7%. Everything else underperformed the S&P this week. In pink, we have the NASDAQ 100 down 2.1%. In brown, crude oil prices. We're using the USO as a proxy for crude oil, but that's down about 3.3%. And then in purple, small cap stocks, the worst performer of the group, down 3.7%. We can add Bitcoin to the mix and just see how that looks. That's the blue line here that started out pretty strong and then came down, ended up being an unch for the week and unchanged, down a bit. I mean, 0.2%, but overall, quite a lot of volatility, but not a lot of directional movement, which is the definition of what cryptocurrencies can do. Even when they don't go anywhere for the week, they still give you quite the volatility, quite the ride to get from point A to point B. So you could have bought gold and had a fairly boring week and had the same end result and probably had a lot less antacids used in your household. Let's continue on and look at the Mindful Investor live chart list. So this is a chart list that I maintain on StockCharts.com. It's my way. It really represents just a sample of the way that I analyze the markets from macro to micro, looking at big picture themes, starting with major averages, looking at breadth, sentiment, and then getting into a bunch of price ratios that I think a lot of times will tell the story about leadership and laggardship, what's working and what's not working. And this is part of my daily routine, really my weekly routine, is going through this list of charts and updating them and making sure they're all set. By the way, if you want to access this at any point on StockCharts, just click on the articles tab, go to my homepage, which is called the Mindful Investor, and you can get to this using the link at the top of that page. We'll start with the market trend model. So I have a 3-part market trend model. This is something I started using years ago just to try to represent the 3 time frames that I tend to focus on. I tend to think of the markets in a very long-term time frame, which is the long-term part of this market trend model. This is using weekly exponential moving averages, and it was really meant to capture the long-term cyclical trend in the market. So over the last 5 years, it's been bullish for most of the time. It turned negative a couple times over the last 3 or 4 years, but really it was limited to the 2020 sell-off that you saw in the first to second quarter, and then the fourth quarter of 2018 when things got a little hairy as well, and the S&P undercut its low for the year in December, by the way. And it's actually an interesting parallel to look at. If you look at 2018 and you look at 2020 to 2021, a little different, but you saw in 2018, you had this big sell-off in the beginning of the year. You made new highs, but then a sell-off and a bottom in the middle of December. And that may be what we're setting up for here. My conversation with Mark Chaikin, I can't stop thinking about it because it was all about how this was the most buyable pullback ever. And he made a decent case for that idea, how a lot of the breadth measures are bombed out, but a lot of good companies, good stocks on sale with a quick sell-off. Makes me think a little bit. Now that was different in the fourth quarter of 2018 because it was a sell-off for 3 months leading up to that low. But interesting, seasonally, we tend to think of December as pretty strong. Sort of the 2019 year is more of the average December. You can see that in 2017 as well, sort of that, slow uptrend. You saw that same thing in 2020. That's what December usually looks like, but you can see an aberration. You can see something a little different. So far, it's starting to set up that way. The medium-term trend model for me is my main risk on versus risk off measure. It has remained positive. It turned positive back in May of 2020 and has remained bullish through that phase. If it would turn negative, I promise I will make some noise and let you know that's the case. Because for me, remaining above the zero line there tells me the long-term trend is still just fine. We get below that, I have to start questioning long positions and thinking a lot more defensively. The short-term model for me is just a quick holding. It's just a quick visual gauge. The daily chart is where I tend to think of the short-term time frame. This is just to show visually what the short-term movement has been. The last 2 weeks have been negative. Given the sell-off today, once again, we have a bearish reading there. So that's 2 weeks straight that it's been below the zero line. The daily chart of the S&P shows you that after Wednesday's sell-off, it's really been more choppy, right? It's been noisy. You had the bounce higher yesterday. You had the turn lower today. We really didn't undercut yesterday's low on a closing basis. We didn't really get above the upper end of that 2-bar pattern. So overall, we're sort of just settling into this range, and we're almost to the penny right at the 50-day moving average. So we violated the 50-day on Wednesday. We closed below it for the first time since October. We closed back above it yesterday and now closing right at it, technically a little bit below it, but this is not a huge follow through to the downside overall. Now, having seen the things that I've seen and looking at the overall trend, my bias for next week, given the bearish divergence that you saw momentum-wise in the first half of this month, given the fact that we've seen a pullback similar in trajectory to other pullbacks, and given the fact that you've seen such negative movements in breadth, I would argue that the path of least resistance appears negative, at least in the short term. I will be happy to be wrong if we get a bounce Monday and going into next week, but overall, it certainly seems to be setting up weaker rather than stronger. And if that's the case, if we do follow through and undercut 4,500 next week, that would bring me down to 4,300. That would be about a 10%, maybe 9% sell-off from all-time highs. That would take us back to the September and October lows. The reason why I think that's an interesting level is a couple of things. Number one, I think you could pull back to that level and the long-term chart would still look super constructive. That would be a couple weeks lower, shake out a lot of people, and then you could rally into the end of the year like most of us are expecting, because that's what the calendar would tell you. That's the seasonal trend tendencies by far is strength going into the year end. We call that the Santa Claus rally. And so that could be that could line up pretty well with the seasonal tendencies that would make sense. And also the fact that it lines up to previous lows, undercutting those September, October lows. I think you'd have people getting climactically negative, getting back below the 200-day moving average for the first time since the first quarter of 2020. That would certainly cause me to be a lot less positive about the prospects for stocks going forward. So that's certainly a downside objective. If we see further weakness, takes us below 4,500 next week. The advanced decline lines have actually changed the color coding system. My very scientifically and super subjective color coding system where I use the stop like green, orange, and red, depending on what I think the breadth measures are telling me every Friday. I changed two of these to a neutral amber, and it's the NYSE advanced decline line and the small cap advanced decline line, because neither of those have made it above their June highs. They actually failed to get above their June high and rotated lower. The NYSE line is the most closest to actually breaking its September low. So think about that. The S&P is still above its September low. The NYSE advanced decline line is very close to breaking down, just bounced off of it on Wednesday. We'll see what happens today. This isn't quite updated for today's close, but a little bit of weakness could quickly make this a new swing low for the last 6 months. Overall, that's not a sign of underlying strength. The two that remain green are the large cap and mid cap, which have broken below their 50-day moving average, but both remain above their September lows. And that's how I try to differentiate those two. Now, again, I was talking with Mark Chaikin yesterday about this indicator. We had a different chart we were looking at, but it's the same idea. We're looking at the percent of stocks above their 50-day moving average. His point, which I'll reiterate here, is the fact that we've gone down to around 30% of the S&P above their 50-day. And again, this is current as of Thursday's close, not quite updated for Friday just yet. But overall, we got down this week to a level very similar to previous bottoming patterns. So if you look in September of last year, October of last year, June, July of last year didn't really get that low, but September, end of September, beginning of October. So the last three occurrences, we got down to 30% of stocks above their 50-day. That was the time to buy, really. I mean, that was the move higher. What I didn't get a chance to talk through with Mark, which I would have had we had many minutes to spend, was That's kind of what February 2020 looked like before we had a much deeper sell-off, right? And I think that's I mentioned when I was talking with Mark, all new highs are bullish except the last one, right? So as the market's going higher, when you get these pullbacks, pullbacks in an uptrend are buyable, but the last one, when there's the all-time high is then established and you start going materially lower, the beginning of that looks a lot like those previous pullbacks. And that's the danger with the buy on the dips methodology, is what happens if it doesn't hold and we keep going lower. So if you are thinking as a buyer here, if you are thinking going into the next week, this is the buying opportunity of the year, I have to start going long, you can totally do that. And I won't try to talk you out of it. What I would encourage you to do is think about the risk. The way you can buy on dips and buy short-term weakness is by clearly defining your risk and acknowledging when your portfolio is not working the way that you might expect. And I would certainly have that in mind if you're taking that approach going into next week. Now, a healthy bull market phase usually sees an expansion in new highs and a decrease or a minimal number of new lows. That is not what we're seeing. That is what we were seeing in early November as the S&P made new all-time highs, as the new highs were expanding and there were very few new lows. And this is the NYSE we're looking at here. This is the S&P at the bottom. Look at how this picture has changed over the course of November into the first week in December. You've seen an evaporation in new highs, less and less stocks making a new 52-week high. Pretty much everything's below that all-time high from earlier in November. You're also starting to see some red on this chart, and the most we've seen since back last year, right, in the previous corrective period. So you're seeing stocks that not only are pulling off of their all-time highs, but they're making it all the way down to their 52-week lows. I didn't mention on the last chart the percent of stocks above their 200-day moving average. That's a non-zero number, and it's worth looking at. Final chart we have time for today, and then we have to take a quick break, is this one. This is the bullish percent index, which is below 50%. I've highlighted in purple the times that has undercut the 50% level. If you look back at the last 1, 2, 3, 4, 5, 6 times, fantastic buyable dips within this bull market phase. But this big red shaded area is what I was warning you about. This is what it looked like in late February before we went a lot lower. And that's the danger right now. So if you think about it in terms of risk reward, could be an opportunity, but I would, as always, think about the risk side for sure. Let's take a quick break. We'll be back with my next segment, the mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after our close, after the close for our show. It's a pleasure to be with you every trading day. A couple quick comments before we get to today's mailbag. The questions from our mailbag today are all from you, our viewers, and our StockCharts users over the last couple days. You can get your questions to us at any point via email, thefinalbar@stockcharts.com, on Twitter @finalbarsctv, on YouTube. Go to our StockCharts channel, put a comment below the video you're watching. We'll gather all those questions, hope to answer one of yours live on the air on our next mailbag segment on Tuesday of next week. Also, StockChartsTV.com is our on-demand platform. I'm super proud of our team and how they developed a beautiful way to represent the great content from all of our hosts, our great guests that join us every week on StockCharts TV. You can go to StockChartsTV.com, use your email address to set up a free account, start watching all of that great content. Also, from your mobile device, just search on the App Store for StockCharts TV on demand. Let's continue on with our next segment, the Final Bar mailbag. As a reminder, keep the questions coming. Email us, thefinalbar@stockcharts.com. Let's get to the first question. We have had many rotations this year. Is this amount of rotation normal? Does the amount of rotations per year mean anything? It's a really good question. I love the way that you asked that, and you've probably picked up. I've used the adjective rotational many times this year because that is certainly how I would define it. There are times when it certainly feels like certain sectors are just working and certain sectors are just not. There are times when the market is more rotational, when it is not a clear picture. And you spend a lot of time thinking what's going to work here in the next quarter. And I would describe this current market as more of the latter. And that's what a rotational market means. Now, there are different ways you can try to represent that visually. I'm showing you 2021 and then 2020 here, the two halves of the chart, and I'm looking at the ratio of growth versus values. This is the IWF versus the IWD. So that's the Russell 1000 growth ETF versus the Russell 1000 value ETF. And you can see just during the course of 2021, it almost feels like for much of the year, every month or two, you have the ratio just turning on a dime and going the other way. So you have to remember that every time this ratio goes down, when I have a little red arrow on there, that's a period when value is outperforming growth. Things like financials and energy and industrials are outperforming growthy stuff like technology, communication services. Then in March, you saw that totally rotated, and all of a sudden the FANG trade is working very, very well. Then in April to May, you have all the banks making new highs and the energy stocks breaking out as well. Then May, June, July, it changes, and all of a sudden the FANG stocks are the only thing you need to own, and you get away from all the cyclical stuff. You even have periods like July, August, September, October, where it was flat, and even within that period, you had these little spurts where these different groups and themes are working. So is this amount of rotation normal? No, I mean, I would say on average, this is more of a leadership rotation environment than we've seen in quite some time. I would say, maybe 2020 is more of a clear year on what a normal environment is, where it's sort of like one side of it is clearly outweighing the other, and you really just need to own growth stocks through most of that period, and you're going to do very, very well. And just recognizing that and not fighting that trend is what's most important. So does the amount of rotations per year mean anything? Absolutely. And I think for me, when I've talked about this year being a stock picking environment, that's what I'm referring to. It is not as easy as just buying a particular ETF or a particular sector and just sitting back and enjoying it and watching your gains pile up. I think this is a year where you've had to be a little more nimble and you've had to look opportunistically. Now, you could just sit in the S&P and you did okay, but you could have done much better by identifying some of those, when is the right time to own some of those themes, and when's the right time to lean into or lean away from some of those different plays. Next question. Was wondering if there is an S&P Oscillator that would say if the market is oversold or overbought. Right now, it's S&P up or down and the VIX staying higher. And I love that question. And what you're implying is, I would argue, sort of the time frame, right? So when I look at my daily chart of the S&P 500, you can see at the bottom I have a 14-day RSI, and that's the most commonly used setting. That's what Wells Wilder, when he tested it and originally designed the RSI, he discovered that the 14-bar RSI was the best measure for everything he tested it on. That's why that's the starting point for most people. But you have to remember that there's a whole way of thinking of this a little differently, and you can adjust these settings very, very quickly. So if you think about it, right, even just making it from a 14-day RSI to a 9-bar or a 9-day RSI, you're basically making the indicator more sensitive, right? So it's going to give you more frequent overbought and oversold conditions, because the period, it actually makes it smooth, basically how much it's smoothing out the data over time. And so a higher number makes for a much gentler turn. It takes the noise out, but it also takes some of the signal out. There are certain indicators that are kind of known for being a little more noisier and a little more tactical. The commodity channel index probably comes to mind. So when I read your question, the CCI is what kind of stood out to me. This is one that tends to be a little quicker movement. Short-term stochastics, the fast stochastics would be the other one that I would tell you about. Both of these are basically looking at different calculations, but like the stochastics is looking at where you're at relative to a range, and just, are we at the upper or lower end of like a 20-bar or 9-bar look back period? And that's a quick way to make short-term plays up and down. So while the VIX has remained fairly elevated, has continued higher today, some of these indicators are actually making shorter term moves because they're picking up on the quicker signal. So if you look back, when the CCI has gone relatively low, you can see that coincides pretty well with short-term bottoms in the movement in the market. So I would look at some of those. CCI would be one, and then the other is the fast stochastics. I think you should study the concentration of one single stock, Tesla, and the XLY. If you use XLY over XLP as an indicator, you will be misled badly. And that's not really a question, but I love the comment. That was actually on one of the other shows on StockCharts TV. I was looking through our StockCharts channel and thought it was a great question. There's actually a lot of wisdom in your question, and you're right. And I'll show you the chart. Probably not the one exactly that you were referring to, but the one that I look at for this ratio, and probably is familiar because we've referred to this pretty regularly. This is the XLY over the XLP up here. And your comment is right. I mean, Tesla is not the largest in the XLY. I think at this point it's still Amazon. Amazon's about 20%. Say Tesla's another 20%, Home Depot's probably 9 or 10%. So those three stocks make up literally 50% of the XLY. And so the movement in this ratio is going to be dominated by movements in those mega cap names, particularly if they're pretty noisy, right? So Tesla's selling off, Amazon pulling back, even though Home Depot's holding up, that's enough to push the XLY down pretty well. So what I actually do, and a lot of the stuff that I do, I often talk a lot more about the equal weighted version of that, the RCD and the RHS. That's the equal weighted consumer discretionary, equal weighted consumer staples. That ratio is also going down, but that is a better pure play on the sectors, one versus the other, as opposed to just those big names like Tesla and others that you mentioned. Next question, how did Tony Dwyer prepare his Powell index chart, the US 10-year break-even chart? That's a really good question. He actually brought up a chart looking at the 10-year break-even inflation rate. And he looked at it on a good period of time. And it was actually really, really interesting. It's not something that I look at very often. This is why, to be honest, I'm super thankful. I think we're very fortunate being able to bring guys like Tony Dwyer and Gina Martin Adams on the StockCharts TV, who are really not technical analysts. They're strategists, but they use so many charts that I think it lines up really well with how we tend to visualize things and try to represent market dynamics. So, the break-even inflation rates, we actually don't have it on StockCharts, but you can get it for free from the St. Louis Fed, their Fed economic data platform. If you go to fred.stlouisfed.org, there's a bunch of data for free, really macroeconomic data. A lot of it's outside the scope of StockCharts.com, but really interesting. And this is one I actually might see if we can add on to the platform, because I think it tells a great story. But that's how you can get that chart and analyze it. And his point was looking at how inflation and using this measure has essentially peaked, and is that the top there? We have time for one other brief question, and I have to share this because my producer suggested that we don't. Does Redmond, Washington really rain almost every day? And the answer is it absolutely does. I'm not kidding. And what I do, if you might find this funny, before the show, I always look out the window and just get a quick glance. And that is an accurate weather report of what we're seeing here. And this period from November to April tends to be a little bit chilly, but never too cold. Consistently rainy. It's rarely a downpour, rarely a thunderstorm, but it is often just this nice little drizzle. What I have learned to love being out here for a couple of years, my kids as well, is that it makes this place look incredibly green. And then the rest of the year, when it's gorgeous and beautiful outdoor weather, it's totally worth it. We need to wrap the show though and go to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is the TNX, the 10-year Treasury yield. My conversation with Tony Dwyer was on Wednesday. If you missed that interview, I would encourage you to go back. It was really interesting to me. And I know from the feedback that I've heard to many of you as well. Tony's fantastic, and he takes a lot of really esoteric stuff, or what you think of as esoteric, about the Fed, about monetary policy, fiscal policy, and he translates that into words and languages and charts that I think make sense. We talked about interest rates, and his proposal, or the idea that he proposes, what if we've seen the peak in the 10-year? What if this 175 level from the first quarter was it? We never go higher than that, and how would that tend to play out? So far, his comments have been pretty well on par here. Rates coming down today as people are fleeing to the relative safety of the fixed income markets, the TLT, the ag breaking out. The 10-year yield down below 140 now for the first time since September. And I'm certainly going to go back and review some of his thoughts as well. But I think that chart of the 10-year could be a really important one to watch. Now, if you think about yields coming off, think about bonds appreciating as stocks pull back. That's why this ratio of stocks versus bonds is turning lower. The stocks to bond ratio, the SPY to the TLT overall, has been a really good measure of just risk on versus risk off. Are people rotating more to equities, risk on, or the defense of US Treasuries, right? Sort of the risk off play. And you can see here, starting in March of 2020, with a couple hiccups along the way, overall clearly favoring stocks over bonds. It's just been such a better play. That changed a bit, sort of April, May, June, July, into maybe early August of this year, and from there has rotated higher. And for the last 6 months, it's really been stocks over bonds fairly consistently. That in a couple weeks has really rotated to the downside. And it makes me think watching that ratio is an important one, very much related to interest rates, the conversation I mentioned before. Now, we only have a minute to go through this chart, and I will try to make it quick, but these are high yield spreads. If you're not familiar with this, Google high yield option adjusted spread, or OAS. It'll explain to you what it is, but this is a way to think about spreads. How much are people paying for high yield debt versus a risk-free debt that they could take on? Now, this top one is plotted inversely. because if high yield bonds are going up in price, then the spreads are coming down and the ratio comes down. This ratio going down is a sign of risk off. This ratio going higher is a sign of risk on, because people are willing to pay more for for exposure to these to this risky market. It is going down. The VIX is going up. I've plotted that inversely as well, and all of that lines up with stocks going lower. The high yield spread going down, the VIX going down on this chart should line up with stocks going down, and that is what we are seeing. Folks, that is our show. That is a wrap for this week on the Final Bar. Thanks for joining us every weekday after the close for our show. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.